Hi, welcome to Online EdVantage. I'm Professor Gonzalez. The topic we're covering is installment notes payable, and we're going to go through the amortization schedule and the journal entries. So what is an installment note? An installment note is, when it's notes payable, is a loan. It's just another word we use for loan. The account we typically use for an installment note is called notes payable. It is a liability, and the reason it's installment is because it is multiple payments. And those payments, and they're equal, those payments are split up between principal, that's the amount paying down the loan, and interest, that's the amount we're being charged for borrowing the money. We prepare an amortization schedule. An amortization schedule will have all the periods covered by the loan. We start off with the beginning balance of the loan, which is how much we got when we borrowed the money. In order to figure out the interest, we multiply that by the interest rate on our loan. And then to figure out the principal, we subtract the interest from the loan payment that we're going to be making, because the payment includes both the interest and the principal. The ending balance of the loan is the beginning balance less the principal, because it's only the principal part that is lowering the loan. At the end of the life of the loan, at the maturity, we will end up with a zero balance because we've paid off the whole loan, in this example, over a 5-period time. The total amount of the principal column will be the total amount of the loan because we'll have paid it off. The total of the interest column is, again, how much we were charged to borrow the $25,000. So in this example, we were charged $7,975 over the 5 periods to borrow $25,000. Now we use that amortization schedule for our journal entries. The first journal entry is to record the issuance of the note, which is when we got the loan. We would debit cash, assuming we got cash for this loan, $25,000, and we credit the liability account, notes payable, increasing it by $25,000. Now on the first payment, we will look to the amortization schedule for period 1. Our payment will always be the same, reducing cash by $6,595, and then we have to split that up between the portion that's principal and the portion that is interest. The principal portion goes to lowering the note, so we debit notes payable to lower it by $4,095. And the expense portion we're increasing by debiting that account by $2,500. And our debits are equaling our credits. For the next period, the cash will still be $6,595, but the breakout will continuously change. And that is because over time, if you look at this amortization schedule, you'll see our interest starts high and then goes lower. Our principal starts lower and goes higher. So over time, we are slowly but surely paying more principal, paying more down on the loan than we are paying the loan fee, which is the interest. Now we're going to do an example. A company signs an installment note on January 1st of year 1 for $55,000. The installment note is for 3 years with a 4% interest rate. Prepare an amortization schedule with an annual installment payment. So if it's an annual installment payment, then we use the 4% and the 3 periods because 4% is an annual percentage rate. So it's for the whole year. And then we're going to do it monthly. When it's monthly, we have to take the 4% and divide it by the 12 months in the year. And we have to take the 3 years and multiply it by 12 to get it in months. So we're going to do that using Excel. And we're going to prepare an amortization schedule. And one of the first things we have to do is figure out the payment. We're going to figure out the payment by using a function. So let's go do that now.
Now I'm going to go over the amortization schedule, preparing it in Excel. I have a basic setup already with the headers, and the first one we're doing is an annual installment payment. So we have 3 years, so 3 periods, and the beginning balance of the loan is $55,000. I'm going to put the payment in. I'm going to show you 2 different ways. First of all, I'm going to go ahead and I have these little sections set up. The interest rate is 4% on the loan. Remember, that's annual, and these are annual payments, so that's fine. And the period's 3. So I can hard code the payment in. Remember, I put the negative in the front to make it positive. I could actually just put in 0.04 and then the 3 periods. And the present value is the amount of the loan because that's how much I'm getting right now. Or I can cell reference, which is really the better choice because then it allows me to do what-if analysis by clicking on the B4, putting the dollar signs for the absolute reference. And then I could also click on the beginning balance, which is the loan amount, the present value. Sure you close those parentheses, that'll give me the same amount. Now calculating my interest, taking the $55,000, multiplying it by 0.04, principal is taking the payment and subtracting the interest from it. And then the ending balance, taking the beginning balance and subtracting principal from it. Now, note that there are templates for this with formulas already put in, but as an accountant and as a business person, you need to understand what is happening with these loans and what's causing them to go down and how much your expense is related to borrowing the money. The beginning balance for year 2 is ending balance for year 1. And now I'm going to do all of it using cell referencing. So it's beginning balance times the interest and then the principal, and then the ending balance. And now I can autofill all of it. I end up with a 0 balance in the loan because I've paid it off, totaling the principal equals the beginning balance. And then we use this to prepare our journal entry. Now, when we're doing a monthly installment, which is more likely, then you just have to take the percent and divide it by 12 and multiply the periods by 3. Now, you can do that right into the function. So I could do 0.04 divided by 12. I can do 3 times 12. So I could put that right into the function. Or I can change it up here, which is a better choice. So I can just divide this by 12. Got to get my equal sign in the front. And multiply this by 12. So now I have a new payment, and I'm going to extend my periods out to the 36 periods. And then I'm going to make some corrections here. My payment's going to remain the same, $16.24 all the way down. My interest, if you remember, I hard-coded this one. That's why we don't want to hard code. This one's not hard-coded, so it's calculating correctly. This one's not, so this one I'm just going to go back and hard-code it. Or not hard-code it, but choose the cell B1. Now, I'm going to autofill it all, as long as I have cell referenced everywhere. Make sure. And I will fill this all up. And my loan has gone to 0. This is the principal here, and that now equals the amount of the loan. So that's how you prepare an amortization schedule using Excel. I hope you found this video helpful, and thank you very much.